Hello and welcome to another edition of Compass, the sectoral chart book from DSP Mutual Fund. My name is Charanjit Singh. I will be talking about the capital goods and infrastructure sector, broad trends in the sector, and explain why we have a positive view on the sector. The capital goods sector has a weight of 2.9% in Nifty 50 index as of February 22, which was 10.5% in the peak of the cycle in December 07. First of all, I would like to define the capital goods and infrastructure sector. This sector is a key driver for the overall development of the Indian economy. This would include sectors like power, transportation, namely roads, railways, urban infrastructure, manufacturing units in steel, cement, and chemical sectors, defense, and real estate. Where we are in the investment cycle. This chart is showing us investments as a percentage of GDP, which is in the green line, and the other line shows us the growth in the investments through the cycle. GDP of any country is derived by addition of private consumption, government consumption, investments, and net imports. Investments mean spending by private sector, government, and households to either purchase capital equipment, investments in infrastructure, and residential housing construction. Investments help us figure out where we are in the cycle. In the Indian context, investment contribution to GDP jumped from low of 26% in 2001 to 40% in 2011. As you can see, the investment contribution to GDP fell to previous lows of 26.7% in FY21, which clearly indicates that the cycle has bottomed out. Also, from the growth perspective, FY04 to 08 investments grew by 23.7% CAGR. 09 to 18 it was 12% CAGR, and 19 to 21 we have seen a negative 2.7% CAGR. India's super capex cycle from 2003 to 8 was witnessed, driven by both government and private capex picking up simultaneously. The capex cycle was started with power sector, followed by telecom and global energy and commodity boom. In this slide, the first chart indicates central government expenditure as a percentage of GDP. Central government capex is one of the key drivers for the capital cycle. In the recent budget, the central government announced strong capex push with 2.9% of the GDP being spent on infrastructure. And if you look at the numbers from FY08 onwards, on an average, we had been spending only 1.7% as a percent of GDP on the infrastructure sector. Despite COVID, government has sustained average 2.5% of GDP as spending on infrastructure from FY21 to 23, which clearly indicates the focus to revive the economy through infrastructure creation. The second chart on the slide indicates the scale up in the infrastructure spending from FY05 till FY21. The key sectors where central government spends are roads, railways, and defense. These sectors overall have seen a scale up from 565 billion in FY05 to rupees 1.5 trillion in FY12 to rupees 4.6 trillion in FY21. So our scale of infrastructure spending has significantly increased over FY05 to 21. In this slide, the first chart indicates annual capex spending by 4,500 listed corporates. The second engine of growth for the capital cycle is the private capex, and this chart clearly indicates that over a decade, Indian corporate capex has stayed flat, while profits and revenues have risen significantly for the corporates. The second chart indicates the capacity utilization. As the capacity utilizations remained low, the balance sheets saw rising leverage and there was a lower demand versus supply. The capital cycle from the private perspective remained muted. As the demand is expected to improve with rising government expenditure on infrastructure, the capacity utilizations are expected to rise. Additionally, low debt on corporate balance sheets and improved profitability are creating the tailwinds for the revival of the private capex. In this slide, the first chart indicates the annual capacity additions by core sectors. FY05 to 12, we saw strong private sector participation in power, steel and cement, led by reforms and strong upmove in commodity prices globally. As you can see in the chart, in the power sector, we scaled up our annual capacity addition from 2 gigawatt in FY05 to 19 gigawatt in FY12. Similarly, the cement capacity addition scaled up from 7 million tons in FY05 to 40 million tons addition in FY12. This led to excess capacity creation in these sectors. Also, leverage for private players rose significantly in both power and steel sector. As demand dropped due to the global slowdown post-global financial crisis and there was a domestic policy paralysis, the capex cycle came to a halt. The second chart on this slide shows the impact of rising capacity additions on the capital equipment manufacturers. There was a significant build-up in the capacities which led to 4x increase in revenues for capital equipment manufacturers from rupees 500 billion to rupees 2 trillion in FY12. As private capex remained weak post FY12, the revenues for the companies in the sector have remained flat, mainly driven by the government capex. How this capex cycle is different from the previous capex cycle? Firstly, scale of infrastructure projects in the Indian context has increased significantly. Past cycles had led to leveraged balance sheets for the corporates. However, in this cycle, the balance sheets have strengthened across large companies. New capex drivers are emerging in power, such as renewables, power distribution. Also, we see rising utilization of automation of factories in the industries. Several new factors of growth are emerging in sectors like chemicals, food and beverage, logistics, data centers, and capex related to performance-linked incentives, which was not present in the previous cycle. Lastly, the valuations for the capital goods sector index have risen sharply post-COVID based on the expectation that earnings growth for these companies is expected to be strong, led by pickup in momentum in the industrial and infrastructure capex. This is also visible in the strong order accretion by the capital goods companies. We believe the valuations for the sector will remain elevated as private capex recovery is happening after 10 years of lull, and government capex is also sustaining, leading to a much more stronger and longer capex cycle. So That's the summary of our views on the sector. If you have any comments, suggestions or questions, please drop them in the comment section and don't forget to subscribe to our channel.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.